You're certainly used to managing risk and volatility, but as you mentioned, with the equity markets, it's been difficult mark to market. What do you think lies ahead? Are we getting past any of the volatility?
I'm sure you've got many more experts than myself on this one. What I can say is we've chosen to de-risk our own portfolio by putting some important hedges in on the equity positions. So on the investment management side, we have been successful in avoiding any impairments, any material impairments outside of some losses related to Russia and China real estate, which were relatively minor. But in terms of the credit portfolio, generally speaking, we've not had to impair any corporate credit along the way in any material amounts. And we look forward, in fact, to a relatively low risk positioning of our portfolio as we finish out 2022.
John, certainly interesting to hear your view on markets, though, versus some of the other views that we get from bankers and fund managers. But let me also ask you about premiums. I can see the net premiums earned increased slightly to $16.6 billion US, supported by price improvements. Do you think we are approaching a ceiling on some of those premiums, given the cost of living crisis, inflation, some of the pressures that a lot of businesses and consumers face at this point?
So in the reinsurance market, I would argue, in fact, that the recent experience and losses in the Nat Cat space in particular has created a supply-demand imbalance, and we actually see this coming very clearly into focus for the January 1 renewals, where while we're committed at Swiss Re to continue to be a major participant in providing cover for peak risks in the Nat Cat space, there's a number of players that have decided to remove themselves from supplying this capacity. And so we actually expect the price increases in January 1 renewals, but also throughout 2023 to materially increase. It doesn't necessarily mean that we will be taking on a larger amount of risk. There are certain layers of this marketplace which we continue to believe are not correctly priced. We will be working with our primary clients to see if, in fact, we can get to a landing spot of what we think is the right economic price for those covers that we offer. But in the meantime, I don't expect the reinsurance market to have much of a constraint on our ability to get major price increases appropriate for the risks that we take.
John, just a question too on gilts, given the dysfunction we witnessed and all the action required by the central bank to intervene. What was the wash up for you as the gilt crisis unfolded?
Well, I happened to be in London that week. I can tell you that our rates traders were showing the same level of concern that everyone else in the market was. The reality for Swiss Re, it's not an important part of our portfolio, and the impact has been de minimis for us on a going forward basis. But yes, I mean, it was a very uncomfortable week for anybody in the markets and the concerns about contagion outside of the UK. And we're pleased to see that it seems to have been contained. It has been important for the UK life insurance and pension markets, and I think there's some adjustments that need to be made in that sector, and we're helping some of our clients think through, is there a solution that Swiss Re can be part of to make some of this volatility more manageable?